This is the third part of Warren Buffett's top quotes to inspire your investment goals. Point number 7. The most important thing to do if you find yourself in a hole is to stop digging. But what should you do if you have already started your investment journey on the wrong foot, failing to do fundamental analysis, focusing on the short term, or yielding to the fear and greed cycle? Well, you have to stop. Staying consistent on a wrong path will still lead to the wrong destination. Therefore, while Buffett preaches long-term investing, that is for those who are already on the right path in terms of investing strategy. For others, there must first be a reversal from the wrong path and a decisive change to the right one. As we saw above, even Buffett is willing to sell a stock if he comes to believe that selecting that stock was a mistake. He will not hold it forever in the name of long-term investing. Rather, he will retrace his steps, sell the stock, and buy a better one. The key is that there is an overarching strategy and methodology guiding his decisions. Change doesn't come about spontaneously. 8. Price is what you pay, value is what you get. This famous Buffett quote strikes at the heart of the value investor approach and reveals the secret of how Buffett made his fortune. After Buffett was rejected by Harvard, he enrolled in an undergraduate degree at Columbia Business School, which is where he studied under Benjamin Graham, today known as the Dean of Wall Street. Buffett was largely influenced by Graham's magnum opus, The Intelligent Investor, which lays out the philosophy for value investing. In essence, value investors are looking for deeply discounted share prices on the market. There is no better deal than a great company that is on sale for a low price, so the value investor mantra goes. To succeed at value investing, you should aspire to learn more about companies in the hope of discovering which are undervalued and, thus, great investment opportunities. This other famous Buffett quote also nicely sums up value investing. Whether we're talking about stocks or socks, I like buying quality merchandise when it is marked down. 9. The three most important words in investing are margin of safety. Margin of safety (MOS) is the technical term that Buffett uses to determine if he is getting a good price on an investment. Basically, it is the difference between a stock's intrinsic value and current market price. For example, if investor A judges stock A's intrinsic value to be $100 and the stock is selling for $50, there is a 50% margin of safety on the potential purchase. The MOS has two benefits for value investors like Warren Buffett. First, it helps them maximize their returns from an investment. If investor A buys stock A at 50% MOS $50 per share, he will make more profit than if he had bought it with a 20% MOS $20 per share. Second, which is more important, MOS protects the investor from the risk that they have overvalued the stock's intrinsic worth. Suppose that the stock's worth intrinsic value is actually $80 and investor A has already purchased it for $90 at 10% MOS, then they have actually paid a premium for the stock. However, if investor A bought the stock at $50 per share, a 50% MOS, they would still have purchased the stock at a discount if the intrinsic value was actually $80 rather than $100. 10. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. One way to misinterpret Warren Buffett's value investing is to assume that the only criteria for buying a stock is that it should be undervalued. This quote seeks to correct that misunderstanding. There are many companies with poor fundamentals that are undervalued. Being undervalued is not an all-telling sign that a stock is a good buy. Rather, the primary task of the investor is to consider if the stock has good fundamentals to begin with, if the company is wonderful. Only when you believe that a company is wonderful should you consider if it's undervalued or overvalued. For an ETF, this means that the price and expense ratio are not the only important considerations. You need to consider the kind of diversification it offers, the trustworthiness of the ETF provider, the liquidity of the ETF average trading volume, how well it tracks its index, and the rating Morningstar gives it. Good pricing and a low expense ratio are important, but they are not the only factors you should consider. 11. Beware the investment activity that produces applause. The great moves are usually greeted by yawns. Successful value investing requires identifying wonderful companies when their market price is well below their intrinsic value. At this point, not many people will consider such companies a great buy. Only those who have seen the durable competitive advantage will make a purchase. And when they buy, it will not be to the applause of the larger investment world. In fact, many people only saw the wisdom of Warren Buffett's approach in the rear view after the purchase had proved successful. Similarly, some of his most successful buys were not companies producing exciting or world-changing products or services. For example, Gillette was making razors and C was making candies. In fact, Buffett was not quick to purchase technology companies, which was why he was able to avoid suffering from the bursting of the dot-com bubble. In essence, successful investing will be proven right from the rear view rather than from the windshield. 12. The business schools reward difficult, complex behavior more than simple behavior, but simple behavior is more effective. Though successful investing is not simplistic, it does not need to be complex. In fact, for Buffett, simple behavior can be more effective than the complex behavior encouraged by business schools. This point ties into the previous one. Simple behavior will not meet with much applause compared to complex stock trades. But those simple actions flowing from time-honored principles can do more good. It's not surprising then that Warren Buffett has encouraged investors to put their money in passive funds, which encourages simple behavior rather than active funds, which encourages more complex behavior. And the fact that most active funds find it difficult to beat their indices while charging higher fees and using all kinds of complex strategies is a proof of the wisdom of the simplicity that Buffett is advocating. 13. The most important quality for an investor is temperament, not intellect. A disciplined investor is a wealthy investor because they have learned that market fluctuations are normal and that patience pays off. In this quote, Buffett touches on the psychological nerve of most investment failures. Humans are by nature irrational beings and are often tempted to make trades when they think the market is working against them. In contrast, it is the well-tempered investor that learns to not watch the market. This is the person that ultimately ends up reaping the most rewards over the long term. Buffett extols that to build more wealth does not require you to be necessarily smarter than another investor, but rather that you become more disciplined with your reaction towards the irrationality of the market. You don't need to be a rocket scientist, goes a similar Buffett quote. Investing is not a game where the guy with the 160 IQ beats the guy with 130 IQ. Thanks for watching this quotes. Request you to like, share and subscribe your own channel to grow like your money.